Hello everyone, welcome to Just-InvestToday, and today we're going to be talking about a book called One Up on Wall Street by Peter Lynch. And I talked about this book in my previous videos and I recommended it in my books list, so if you want to watch that video again, you could. Um, but I really want to talk about something very important that this book mentions. It talks about 6 categories of stocks to look out for kind of before you invest. So the 6 categories it talks about are turnarounds, asset plays, cyclicals, slow growers, medium growers, and fast growers. So when this book talks about all those type of categories of stocks, it's trying to keep your eye out. It wants you to look for companies that are still growing. So you're not buying companies that are very slow and not growing a lot. They're just growing at the amount of GDP, or maybe they're just growing just at the industry level for that specific company. Because you want to buy stocks that are continuously growing at like 10%, 50%, 20%. Like those are the companies you're going to want to buy. That's going to give you a lot of money and that's going to give you heavy, big returns in the future. In this video, I'm only going to talk about 3 out of the 6 categories of stocks and businesses to buy. So the first one I want to talk about is the slow growers. And the slow growers are going to be stocks that have been going on for like 10, probably 15 plus years, and they were fast growers, but now they're very slow, and they're not the same fast growing company that's going to generate 20%, 10%, 50% profits. They're more established kind of companies. So when you're looking at these type of companies, you want to look at how much profit are they generating year over year. How about the sales, and like what is that going over year to see kind of what's the average. If it's only generating like 3% a year, 4% a year, you probably don't want to invest in it. You probably want to look for a different company. And so that's one way you can tell. Another way you can tell if it pays like a big, large dividend. Companies that pay a big, large dividend usually are not going to be growing. They don't know where to put the cash, and they're not really reinvesting that money back into the business. So that's another way you can tell what a slow growing company kind of looks like. But if you really want to know, you just look at the charts, you look at their revenues, just look at the revenue, sales, and all that type of stuff. How much net income is the company generating? The equity, how much is the equity growing? If it's not growing 10, 15, 20%, then you probably kind of want to avoid these slow growers. So the second category of stocks we're going to talk about is medium growers. So these companies are faster than the slow growers, but they're still not as fast as the fast growers. So these companies are going to be averaging around like 10%, 11%, around that kind of marker when you're looking at them. So they're probably going to generate 10% on net income, revenue, and equity. They're only going to be generating around 10, 11, 12% on your returns on your money. So you kind of want to look at that if you're looking at charts and seeing year over year where this company is going. And these companies are still very good companies, and they've been in the business for like 5, 10 years. So they're very strong companies, and they're actually very good companies to invest in. But you got to know if it's a slow grower or a medium grower, right? You want to make sure of that. So you know when you're investing in a medium grower, you should get it at a good price, right? So if you're investing in a medium grower, you want to get it at a very good price. So when it does boom, you're getting a really good return because you don't have to wait for it to go generate like 20, 30%. If it generates 10%, it's still a very strong return. So it's okay to get these companies and hold these companies as long as you know that you're getting it at a very good price. Also, these companies are actually really good recession-proof companies, especially in a time like this during this pandemic. It's a very good, solid company to look for. These companies are, like I said, they're very established, like 5, 10 years, probably like Nike and like companies like Walmart. They're only generating the revenue is probably increasing by 10%, maybe 8%. They're not going crazy, but they're still strong recession-proof companies, so you don't have to worry about them in like times like this. So these are good, strong companies to hold, and it kind of keeps your mind settled, and you don't have to worry about them going bankrupt or anything like that. So medium growing companies are still very good companies to invest in, but you just got to make sure you know it's a medium grower. So for the third and last category, we're going to talk about fast growers. And these companies is what kind of Peter Lynch wants and what he kind of looks for when he's buying a company. And these companies are going to be generating 20 to 30% revenues and net income a year. Like year over year, they're going to be generating that much percent of returns and revenue. So you got to be cautious when you're looking at these companies because these companies they're small and they're very aggressive on their expanding. And when you find these companies, you got to make sure there's a lot of room to grow. So you wouldn't like fast growers can't be a company like McDonald's or Nike because there's not a lot of like stores they can open now because they're very saturated in the market. So when he's looking at fast growers, he's looking at companies that are very small and they haven't expanded a lot. They don't have like maybe not a lot of stores and they can have a lot of room to grow and keep opening stores and keep opening restaurants or whatever business it's in. So when you're looking at these fast growers, you got to make sure there's a lot of room to expand. And this is what he kind of looks for because these companies are going to double your money, triple your money, quadruple your money in like 1 to 2 years. And this can make or break you because when you get in companies like that, you can have 2 or 3 bad companies in your stock holdings. If this company is going to triple, quadruple your money, it kind of makes up for those medium growers and slow grower companies. So Peter Lynch really looks out for these fast growing companies. So that's it for the video. I just give you the breakdown of the slow growers, the medium growers, and the fast growers. And just to end this video, I want to talk about my opinion. And I think the best companies is to get the medium growers. Like the medium growers are going to make sure you get 10% on your money, 12%, and you're not worried about the company going bankrupt. And it kind of gives you a peace of mind, and you're not really worried about if it's gonna go down or anything. You know it's gonna slowly grow, couple years, 2, 3 years. But if you can find a really good company that's a fast growing company and it's a solid and you understand the management and you know these people are not going to be overzealous, they're not going to be going crazy and trying to do too much and having a chance to go bankrupt, then the fast growing companies are actually the best companies to buy because you're going to triple, quadruple your money in like 1 to 2 years. So that's my opinion on those type of stocks to buy. That's the end of the video. If you like this video, please leave a like, comment, and subscribe to the video. And I'll see you guys later in the next video. Bye.